Hi, this is Randy Finney with Right Side of the Chart, and this is an early session or really midday update now for Monday, November 13th, 2023. It is 12:11 p.m. as I'm starting the video, so what I'm going to do in this order is talk on the equity markets, not an in-depth, but more of a brief update where at those key technical levels covered last week quite a bit. I will do an update on Treasury bonds. That is to me, everything right now in the market, if you can gauge or kind of get an idea or prediction where treasuries are going, or even react to the levels. You don't always have to predict. You're not always going to get it right, but you need to react to key levels if and when taken out, breakouts, test of resistance, whether you're rejected at resistance levels or breakout above resistance, ditto with support. So I'll get to that. Again, that won't be in depth because there's not a lot different from last week. I'll make a point to update some of the recently highlighted trade ideas. As far as the commodities trade ideas I've thrown out recently was OJ, quite a bit over the last couple months, agricultural commodities, stating that I favored ag commodities over broad-based commodity ETFs, particularly DBA. That's your agricultural commodity ETF if you want a one-size-fits-all. And then I will touch on the non-ag commodities throughout crude oil as a trade idea last week. And I get constant inquiries about natural gas, so I'll update that as well. So sounds like a lot, but let's not spend too much time on it because, again, it's kind of a recap from last week. This is the primary downtrend line in what I will refer to as the stock market. You have again, I have to reiterate the importance of the fact that the NASDAQ 100 is not a very diversified index, even though it has 100 stocks. It's the overweighting of the top components that make it pretty much just a juiced up tech ETF or tech index, if you will. However, it is, I will and need to recognize the fact it has broken out because a lot of traders trade it. So technically, if the NASDAQ or those big market leading fangs break out, that is something worth noting. But again, we'll get to that. So like I said, broad-based, you look at SPY, the S&P 500, you can look at the equal weighted NASDAQ 100, and you get the same thing here. I have a different boards, but you have pretty much the equal weighted, also at downtrend line resistance. I've mentioned as far as ETFs go, there's probably no single ETF out there that is more representative, and you can look this one up. But there's an index that tracks. It's a broad-based, a basket of numerous stocks that encompass both all the spectrum of stocks in the U.S., small, mid, and large cap, and that's VTI. And you'll see the same thing if you look at the Wilshire 5000. So again, the common theme that I've been highlighting is the stock market, the most diversified and representative index that are representative in the entire stock market are all at significant downtrend line resistance. And many of those also have pretty good price resistance as well in this area here. And then the NASDAQ 100, because of the extreme overweighting and narrow concentration in those top mega cap stocks, the Magnificent Seven, that has broken out. And so, again, that's worth noting. It's, like I said, it's not you can't spin that as anything but bullish for especially that particular index. But as I said, a lot of eyes are on this. And if you only trade QQQ in a vacuum or the NASDAQ 100 futures, you're missing the biggest picture. So as powerful as those stocks are, as far as their impact on the indexes, if thousands of other stocks collectively are all running into resistance at the same time, you need to see those levels taken out. And I will go back to that. My expectation where I think things are going, but it will be hard to spin this as anything but bullish if the S&P 500 breaks that, and then you have just above it at about 44 to 444 to about 445 on SPY. You can see very good price resistance as well, and that's just slightly above it. So, and this kind of dovetails. If we were to pop that, it would dovetail with the, I gave you the VIX futures and VXX today. I showed you another setup in that. Last time we hit T2 out of T5, 5 targets. We hit the second target, each one giving you, divergent high and a chance to short support the pullback and get in at lower prices. It didn't work there. We had a shot at the trend line. We kept going through, but we are at support. Put a little bit of a lower weighting on this support level. I commented on this last week to somebody about the VIX. These VIX tracking ETNs, they suffer from all kinds of types of price decay. Over time, they're guaranteed to lose money no matter what the VIX does, and I'm saying over a long period of time, because the VIX itself is range bound, but these guys have expenses and other issues, constantly rolling futures. So that's VXX. The ETN. So you really got to use it as more of a hit and run vehicle. And you can see this is a long-term, a weekly chart. I was showing you how VXX will always go down over time. So it's not a buy and hold instrument, but VIX itself is range bound. And you definitely want to look at that. And you can use the charts of the VIX as well. And just like I gave you VIX futures today, and you can see the spot VIX had a support line here. Actually, that goes back all the way to August 1st. I would probably tweak it a little bit, but then let me just move this, delete that. I want to put a horizontal line here because I gave you a scenario on the VIX futures and VXX where I could see the potential. So you have positive divergence right here, right? And you also have, remember, as I said earlier, and when I put that trade idea out, part of that is you're also, to go long the VIX is basically a proxy short on the indexes. So you have SPY and every other diversified index other than the NASDAQ 100 at significant resistance, not little resistance. And you have those 60-minute divergences. So I really like it. They're very objective and to short here. And then if we happen to spike up, let's just say, like I showed you a minute ago on SPY, maybe you pop that trend line, should be a huge stop clearing move. You'd probably have a lot of shorts with stops on the other side, and you're probably bringing a lot of longs. And then if that fails, which I would put good money based on the divergences, that would be a huge bull trap. Now, that may or may not happen. So I gave you the post this morning. I'd rather go long here, or I said you can scale in. And then if you do get one more thrust down in the VIX, that's going to coincide with another thrust up in the market. And as you can see, as I'm drawing them out here, that would coincide with a just a bigger divergent low and give you a kind of clean divergence. This kind of divergence sometimes plays out. What I'm referring to on this type of divergence, when you look at the PPO, ideally I like to see clean separation in the peaks. Like here's negative divergence, peak 1, peak 2, with nice trough between. There was a divergent low, see lower lows in price with clean separation on with the positive divergence there. Again, sometimes you get that, and I will promise you I'll be highlighting it if and when we get there, if there's another objective long to go. But sometimes you're looking for that, and you just might not get it. Sometimes this type of divergence plays out. So in a nutshell, the reason I favor it going long here and would add to if we get that another low is, again, because of what I started the video out with, SPY and everything else at these major primary downtrend lines right there. So that's that. Nothing else to say. Take that shot 100 times out of 100. If you take that shot 100 times, the market's overbought into resistance with negative divergences. Again, you have nice clean divergence here on QQQ. And should we pop a little higher, those divergences would simply be extended. They're not going to be negated anytime soon. They could ultimately be negated, but you'd have to come up quite a bit. As of now, any additional thrust higher is just going to extend the divergence. So hence the reason I still like shorting there. And shorted here, and I'll keep pointing those out. You miss 100% of the shots never taken. And on that, nobody bats 1,000. So you're going to, not hit each and every time. But if you do this long enough, remember, we were long off this divergent low, long off that one. We gamed final target. Believe me, I've seen the snide comments on the site. Some people come out of the woodwork about all these divergences don't work. These were all here. We were short here. In fact, if you shorted, and I spoke to that many, many times since this divergent high and this little wedge break right here, I spoke to different traders that wear different hats, or myself wearing different hats. As a trend trader, you're still profitable. And I said you don't have to game. I'm always going to try to game the squiggles. And if I'm not trying to game them myself, I'm going to point them out for others that might want to game them. I'm going to point out developments. And so anyone that shorted that divergent high, that wedge break right there, is still positive on that trade. I'd see a little crying, spilled milk on these last couple shorts that didn't work out when the divergence started right here, and a short at the downtrend line. But basically we went up, pulled back, hit that. I did in recent videos said, well, the first target, even though I had T1 here, first support level and pullback target's actually going to be the downtrend line, because that would be the obvious first support level, and we bounced there. So that's it. Take it, don't take it. I'm going to get into treasuries, and before I do, I'll segue into that by going over the economic calendar one more time. Okay, I wanted to talk on this briefly, and then it will it will tie in to my analysis on treasuries. So let me change that tool color, blue. So tomorrow, CPI, certainly a big one. Consumer Price Index, one of the best measures of inflation. Forever and a day, there's been a lot of criticism that the government underreports. That doesn't matter. Let's just watch it because the market will react to it. And then you have PPI, Producer Price Index, final demand. That's also will give us some indications on inflation. And retail sales, that's a big one. Consumer spending accounts for over 2/3 of GDP, so always a potential market mover. And jobless claims, one of the big ones to watch. We get those every week. Then over here you have housing starts and permits. So let's talk about the CPI. Then we'll roll into treasuries, because again, that has to do with interest rates, which have to do with inflation, whether real or perceived expectations. So okay, and inflation is just a basket of goods and services. As far as the CPI goes, basket of goods and services that's measured every month. They take spot readings throughout the month. Tons of things out there, and that includes cost of housing. They use owner equivalent rents, not particularly home price sales, but that's going to go hand in hand. Obviously, when the price of homes are going higher, rents are going higher as well, and etc. That's the one that we don't have a very accurate real time. You almost have to kind of project and predict on where things are going there. But what we can measure in real time, and again, it doesn't give you the exact numbers of the CPI. But we can look at things such as various commodity prices, food and energy, gas, and if you want to track where gasoline prices are going, you want to chart UGA, unleaded gasoline ETF. Very, very obvious chart. Last week, pointed out bullish developments and stated crude is along. Likewise, you're going to see nat gas follow. Gasoline up today. You can draw up the levels here. I didn't even have it marked. You can trade this. And so now whatever happens here is not going to be reflected in tomorrow's CPI number. I'll get to that in 1 second, what will be, because again, they're going to report October readings for inflation, CPI for Consumer Price Index. But this looks like just like crude oil, which you can use the ETN USO. Hit support. It's been moving up recently. Okay, let's jump over to that. Because of all the commodities out there, I will go on record, and this is not my wheelhouse. I'm not an economist, but I've been doing this a long time. To the best of my knowledge, this is the one that probably is most accurately reflected in real time. In other words, if we look at where crude and unleaded gasoline prices and heating oil and all that stuff, if we look at where they were and where they traded throughout the previous month, in this case the month of October, we get a good idea on what their impact on inflation would be. Because simply at what I just showed you in UGA and on crude, those are the actual prices at that moment, tick by tick throughout the day. So we know that if somebody working for the BLS, that's the Bureau of Labor Statistics, through the government, and they went to a gas station, recorded gas prices on blah, 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 those dates, that's what they're going to get. So that's real-time stuff. I think you follow me there. I'll get to the agricultural commodities in a second. See that they don't measure. To the best of my knowledge, I don't think they include the spot price of wheat, what it's going for, market or the futures. But they do look at a loaf of bread. So there's going to be a lag there. But overall, it's the trend. When you look at the trend and you see rising prices on various grains and lean hogs, live cattle, all that good stuff, you're going to eventually, those prices are going to permeate into or translate into higher prices at the supermarket. Okay, but I'll get to ag commodities in 1 second. This is crude oil. This was last week, I think on Thursday, whatever November 9th was. I highlighted crude as bullish, put in a divergent low. Looks like it's going up. And we were right here, and this is what I said. We'd probably go, I could see it going here, hitting that trend line, get a little reaction, and work our way up to 80.11. Really nice. Again, the lines in this chart right here, this is the screenshot from the video. I just paused it on that coverage at the 726 mark. So that was then. This is now. Boom. We're pretty much at the first target. But I still favor, I think we're going to go up to at least this level. That is a very nice resistance level. Excellent opportunity to take profit. If you want to game, you could try to game a little reaction here. Personally, I think it's going to, I'm going to hold out and just let it try to run up to about $80 there, a little shy of that 80.11. And then take some profits, maybe reverse it if the intraday charts indicate that. I'll have to, after the video, I'm going to look and study the intraday charts. I didn't even do that now. I can't get too granular in these videos, or I'm not going to be able to cover everything I want to cover. Which is next. Let's talk about that. So there's this broad-based commodities. DBC is a broad-based commodity ETF I've covered in the past. It's a one-size-fits-all. You want to know an ETF to buy because you believe over time you want to put some money away in a long-term account, 401, IRA, whatever, and you want to have them all. You want to have the energy in there, and this is why I want to point out that, you have to really focus on what oil and gas prices are doing, because most of these broad-based, all-inclusive commodity ETNs or ETFs have the majority of the money into energy, because it has such a big weighting on the commodity indexes and the economy too. So please don't get me wrong. It is very important where oil and gas, because the price of oil and gas, it permeates into everything else. Just from everything, think of the widgets sitting on your desk to the TV on your wall to whatever. There's that energy, is used to pull raw materials out of the ground that makes the plastics. Plastics are petroleum-based products. Everything has plastic in it, just about. And they got to put it on a ship, goes overseas and gets on a train. So energy is by far the most important of all commodities as far as inflation. It trickles down into everything else, even ultimately, costs of, getting corn and wheat to the market and shipped from, the farmer's field to wherever it's getting processed finally into the grocery store and back to your house. So that's that. But this is what it looks like. And remember, it's been bullish. I've made the case for a long time. We're in a new secular bull market in commodities. It's early on. This was just the first initial leg up, followed by a beautiful little bearish rising wedge. Divergent high, we had a correction, put in a divergent low, and then broke out right here. Let me move this away. And then we've been moving higher, and that's DBC. You can also use DBC is the ETF. And then what I want to look at is and DJP, which is really another same thing, but it's an ETN. It's just one that I've had charted for a while, and I've done for you if you've been with me for a while. Every now and then I try to make a prediction for the CPI using this chart. Again, it's the same kind of broad-based commodity tracking ETF, or ETN in this case, just a technicality there. You can see it's got all the usual suspects. 40% energy in this one, 20% grains and oil seeds, 16% precious metal, 13% industrial metals, almost 6% soft commodities, and then 4.5% livestock. And again, you can go to the company's website. So it's a very well diversified ETN that shows us, tracking a commodity index, and it's just going to show us where prices are going. So I've done this many times, and it's been a damn accurate predictor. We've been able to predict with pretty good accuracy which CPI numbers might come in hotter than expected and which ones might be coming in cooler than expected. And again, looping back to what I said earlier, the way the CPI is calculated, there are spot readings throughout the month. So you kind of have to eyeball an average, and this is what I do here. I do these little boxes, and this is October right here, the most recent month. And so you started out here. This is October 2nd was the first day of October, this candle right here. So we went down a little bit, back up. That brought us back to about even, but that would bring it, give us slightly cooler numbers. But that was the first week and a half of the month, actually almost halfway through. Then we came up here. So just kind of eyeballing this again. If I put a fast moving average or anything in there, you would say that prices overall were a little bit, at least again, through this ETF. And again, there's a lag time on some of these, but most of the trades, most of the commodity prices were higher than where they ended the previous month. Right here, this big red candle, I think you can see it. I'm drawing it out for you. That's where we ended the previous month. So we had a little bit down there. So it's hard for me to make really a strong prediction here, but remember now what I said a second ago, that these are spot readings of actual, the components in there, and you can Google search and see it. Like I said, it's a gallon of milk, a loaf of bread, a trip to the doctor's office, services and goods. But the trend now, okay, remember, the markets are cheering, because as expected, we had a pullback in rates, which was technically induced. We called for that. We were in right at the lows, probably at the bottom on treasuries, caught most of this bounce. As I said before then, for the last couple of months, the markets are hypersensitive in trading right in line with treasury bonds, which is inverse to interest rates. So we've had an abatement in yields that caused a sharp rally in the stock market. And overall, if you look at the trend here, turn off all the lines, you can see since the end of May, commodity prices have been rising. And so, again, even though we it's somewhat flattish for the month of October, or back here, wherever I just drew it, some of these increased prices should carry through there. And we'll look at that again. So watch it. And guys, by the way, I'm not making a big prediction that the numbers are going to come in hot or not. And when I say hot, it's above expectation. We'll take a look at where expectations are. I'll be honest, I didn't even look yet. I'm going to look at that right now in a second here. But keep that in mind, that there's a lag effect. And what we've seen is a clear trend. And if you follow the headlines pretty closely, I think it was about a week ago, the Central Bank of Australia raised rates, and they did so. And that was the first central bank around in a while. The trend lately has, for a long time, has actually been cutting rates, and markets cheering right now because the Fed's pausing. But Australia did it because inflation's rearing its ugly head over there. And so, it's safe to say that, there's going to be an increased chance, and that chance could go up sharply tomorrow. I'm just saying it could. So we watch the inflation numbers, and if it does, the market is not going to like that. Bonds aren't going to like that. And that could really give us a rejection off those levels. Remember, it all kind of ties in together. The stock market's at resistance. Let's just go from there. Do what you want. I can tell you right now, and I will say my opinion's strong. You might have your opinion where it goes. I have my opinion on where things are going. But I can tell you with 100% confidence that I believe it is not objective to go long right now, because it's trading 101. When something rallies up to resistance, you either, if you think it's going to pull back and reverse, you short it. And if you're bullish, you wait for a breakout above resistance. So it's just contrary to trading, especially on an overbought rally, to go long at resistance. And for me, that's where the divergences and the price action of stocks and volume, I've covered all those things lately, that's where they come in. And then I try to ascertain, okay, which rally into resistance is likely to result in a breakout, and which one is likely to result in a pullback. So here's a SPY on the S&P 500 on a 60-minute chart. beautiful clean downtrend line, negative divergence. And even if it pops it, you've got resistance just ahead. So that wouldn't shake me out. My stop would be somewhere there. Oh, and you also have, of course, the primary trend line. Let me go back to my daily chart. Give you a clean board here, right there, that red uptrend line, which you can see extended. So there's a whole confluence of resistance overhead. And any pop to test the 445-ish level or a back test of that primary trend line right here is simply going to result in a, let me go to the daily chart here, guys, sorry. We can go a little bit farther back. There's the trend line. That is the trend line. That's the one that comes off the bottom in mid-October of 2022, and that's just above as well, okay? And now look, if we pop, and we take that 60-minute divergence out, that is going to be very, very hard to spin as anything but bullish. And so let's see. Like I say, you can have an idea where things are going. I always try to map out a plan where I think things are going, and then you have to react. Sometimes it doesn't work out the way you think it's going to. So if we start popping there, and now kind of rolls me into treasuries, we have the big one to watch is the 10-year, that's TNX. And this is just a super mega important uptrend line, in my opinion. It is the primary uptrend line off the COVID lows, I call them, back there where the market fell off a cliff. And it's pretty well defined. You have a couple spikes that I've excluded there just to come in and capture, especially most recently. If you zoom in, you can see a lot of reactions there. And as I mentioned last week, and that's where I kind of did not a complete backpedaling on my bullish views. I've been, told you very bullish and long treasuries right off the lows, got that up to you as a trade idea. But looking at this, I said, you know what? It looks like that trend line is going to go, and we could have a much bigger rally in treasury bonds, meaning yields fall much more. But as I've said it, if I've said it once, I've said it 1,000 times. Support is support until and unless broken. This is a bullish uptrend in yields, and all we've done is pulled back to that trend line. Yes, there's divergences, but as I like to say, divergences are not a buy or sell signal. So it would be, everybody, again, they've been high-fiving. There's FOMO right now in the stock market because we've had the first half-decent pullback in yields. But if it goes the other way, there's going to be it could be a big move down in the stock market, because that would be a big what it would do is this recent rally that we had in QQQ, especially the tech stocks, but just about everything, it reeked of short covering on volume patterns and a lot of things. And remember, we also had a lot of stuff hit my price targets. As I go through my things to watch lists, we had like the home builders and a lot of other sectors that were rate sensitive. Home builders hit T4. I'm just rifling through here. PSP hit support. The banks, remember XLF, super important sector, especially right now. The financial sector hit that purple key uptrend line support with positive divergence. So, the case, and it was clearly made back here, super strong, that we could at least have a rally. We've had the rally. And the $1 million question is there going to be more? Are we going to pop these uptrend lines or downtrend lines and continue? As of now, I'm betting no. Favoring no, but this is where things start to change for me. On those uptrend lines I gave you in the beginning of the video on all the major stock indexes that are being tested, you break out on the financials, then that's going to change the technicals. I don't have each and every one here, but there were a lot of them that hit, Visa, MasterCard, all the things I'm watching, the FedEx, UPS, a lot of these stocks tested or hit the 200-day moving averages. Again, these are the ones to kind of give you an idea on the market. Continue to watch paychecks very closely. Big payroll processor, give us some signs on where the job market's going. Again, it hit key support with positive divergence, but it also is at downtrend line resistance. So that's it. I can make a case, a strong case. I made a case there was a bounce to be made, but now we're at really good downtrend line resistance. And, at the very least, probably a pullback trade, but at most, that could be the end of the run. As I mentioned, this is usually, and I said it before, I said it a few weeks ago, this is the most bullish setup. I said it several times in these videos in the market that I've seen since the beginning of the year right here. We had on the 60-minute chart big divergent lows, and then all the big fangs. Most important, you don't see it here in QQQ, but we were long Apple and Amazon and everything else and overweighted the Qs. And this right here was the most bullish setups I've seen since then. And we've had one of the biggest rallies. I overestimated how far it would carry without a pullback. But I also said if we are in a bear market and this was the high and just a counter trend rally right here, then, and I said in advance, this rally would have to, right as it starts to look so good to just about everybody, and where they start declaring, we're going to new highs, it was just a correction, that's probably when they'll step in and sell it. So it's still a kind of a working theory, but that's the nature of bear market rallies. And you can go back, and I've done this in the past, showed you in 2008, right before the bottom fell out, we had a comparable bear market rally. It was right about 10% too in the Qs, and off of divergent low, and then boom, the bottom fell out. So I think the economic calendar, guys, and where rates go will determine how this is going to play out. So watch it closely. I showed you TLT. I showed you IEF. IEF is the 10-year Treasury. Remember, I showed this last week. The 10-year Treasury bond via the ETF hit resistance, and so far is getting rejected. And to be honest with you, I'm surprised that the NASDAQ is not down more than it is with this pullback in the 10-year. One of two things is going to happen. I think the market's playing a game of chicken with that, so it's disconnected somewhat for the last couple of days. Remember, this pullback here rocked the markets on Thursday. Then we had a little bounce on Friday, and the market had a big rally. In my opinion, it just reeked of a lot of short covering and FOMO, kind of fear missing out trade. But here's the technicals. These are the facts. We are below that line. Take that out, and we start walking away from that downtrend line. That means the TNX and TYX, the yields on the 10 and 30 year are going to start continue to fall. That's going to be net bullish on the stock market, unless we get that other prediction I've been making now, that will start to, going forward at some point, and maybe this is the beginning of it, see a decoupling from that strong correlation between the stock and bond markets. And by the way, guys, it's not just treasuries. Treasuries are, first and foremost on my radar. This is LQD. These are investment grade corporate bonds. And a sector or an area of the market I'm watching very closely. It also got rejected at downtrend line resistance. This was where I got bullish on them. It just like treasuries, they broke out at the same time. They had the same bullish falling wedge. That was the same breakout candle when we went long on TLT and the 30-year bond. But it also came up to a downtrend line resistance, and so far is below there. It's consolidating. I'll give it that. Nothing goes up forever. Maybe it's just consolidating to work off the overbought conditions and wants to pop that. And if it does, that's going to be, again, net bullish for equities. However, if it doesn't, as I like to say, resistance is resistance until it's taken out. Then the stock market need not get too excited or too far ahead of itself, because the longer or the more we start to move lower, the stock market, QQQ particularly, will have a big game of catch up to play to the downside if it realizes that this little pop in bond prices, which was a pullback in rates, was only a brief counter trend, move like this one. Okay, quick update on the OJ trade, orange juice, perfect Fibonacci, 50% Fibonacci retracement. That's from the high. Remember, we shorted the day of the high. If you took it, I told you, I know most probably didn't take it because there's not an ETF that I know of or an ETN that tracks OJ futures, but we had that parabolic run up, and oops, can't get rid of this. And the candles are wonky right now. It's not working out on the daily, but this is what we're looking at here on the. So we're at the 50% Fibonacci retracement, which provides for an objective short entry if you miss the initial one or an add-on. So I still like that one. And then the other ones I liked, covered USO, didn't I? Yep, I did. I covered crude futures. That's also USO. Again, you can trade on the 60-minute. Different boards here. There was a divergent low right there. See, nice positive divergence. Again, this is what was mentioned last week. And so there's that downtrend line right there I just showed you on CL in the beginning of the video. So maybe a little pullback and another thrust up. Probably right there. You have to I have to correlate that level on the futures. I'm using the futures. What else was there? There's natural gas. Giving you my opinion, natural gas has just been this mega sloppy range for a long time. And unless it takes out T2, it's hard to get excited on. I did an update last week. We took out the uptrend, the uptrend line off the June lows, which in itself wasn't good, but we were at that support level there, and we have bounced. But again, and so you can look at it that way. We're at the bottom of a range, that's been violated a couple times. But other than that, this is where natural gas has fallen to since April. And when it does, the next stop is usually the top of the range. But again, the top of the range is not super well defined either. It's just more of a, again, sloppy range. So I have no other word for it. And then if and when T2 goes, that'll open the door for more upside. And again, something to watch because that also plays in inflation. But natural gas doesn't have the impact that crude oil does on the CPI. Okay, that's it. That's what I wanted to cover. Just kind of an overlook, broad view over on the commodities. And I'm sorry, I was trying to think. This one I meant to mention to you and I didn't. This is one that I mentioned a couple months back and several times since as my preference over the broad-based commodity ETFs because you strip out now. You strip out oil, natural gas, all energy. You strip out industrial and precious metals, which are demand-sensitive things. So my view is the economy is rolling over, and we're going to go into a recession. That's I think the wheels are in motion for that already. Unless the last pillar, which always is the last pillar to go, and that's the job market, until that rolls over, it's kind of been a slow transition. But if so, you're going to see demand destruction on those hard commodities. You're going to crude oil and industrial metals and precious metals, of course, can get their own flight to safety bid. Gold can kind of do its own thing. However, you can see this steady rise in clear uptrend in agricultural commodities. Again, this is DBA. So if you want to exclude the others and you want to just check off and have cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, that's live cattle, feeder cattle down here, lean hogs, cotton, you got it all here. And you have a pretty darn clear uptrend. It's hard to argue. We're kind of almost forming an ascending triangle pattern here. So if we can pop the recent highs, that should take us up and then challenge the previous high from 2022. And again, long term, if you look at it, we're coming off a bear market in commodities that ended with the COVID lows. And this, to me, bigger picture, looks like a first leg up. Nothing goes up forever. Corrective wave. I mean, it happened right at really good resistance. Charging back up. So when we pop, if and when we pop that previous high, about 23, again, you can see it here on the daily chart, that should be a pretty powerful breakout. So we'll keep an eye on it. We've got some divergence. But remember, in a bull market, negative divergences often either result in a relatively minor pullback or sometimes just get burned through and taken out until they're no longer there. But again, at the end of the day, it's a way to diversify. Don't put all your eggs in one basket. Sprinkle a little here, a little there. When the time is right, gold, crypto, long or short. Again, it doesn't matter. They're just different asset classes that are uncorrelated to the stock market and bond market. So I'm going to wrap it up. Oh, no, I won't wrap it up here because I just mentioned crypto. Sorry, guys. GBTC, no change. It's still back testing. The same, again, there's no update since last week. Last update I gave you was right here. We had a sell signal breakdown. As I said, sometimes you break down, never look back. You go and hit your targets. And then sometimes you break down from a bearish rising wedge and you back test the wedge from below and then you go on. And then sometimes you break down and it's a false breakdown and the divergences get taken out, meaning the PPO starts to make both indicators, PPO and RSI, take out those previous highs, and then you no longer have a case to be short. But as of now, that's where we're at. And it's still, like I said the other day when we were back testing, I said, you'd probably at that point want to have a stop not too far above those recent highs, especially if we recover back above the uptrend line there. Okay, and that is it. If I missed anything or you want an update on anything else, whether it's something I've covered or not, by all means, just post it in the comment section below. I'll do my best. I haven't been able to catch up yet from the last couple posts, but I'll go through those today and make a point to answer any questions. This has been Randy Finney with Right Side of the Chart. Have a great day.